Today, we're going to be talking about the top 3 reasons to avoid infinite banking. Rod, tell us what infinite banking actually is, and then we'll get into the top 3 reasons why you must avoid it.
At its most basic level, infinite banking is setting up a high cash value life insurance policy that is optimized toward growing the cash value, right? We want to have money in the cash value that creates an asset. Then you take a loan against that asset. So your money stays there. You've taken a loan and you're using that for all kinds of things, going on vacations, paying your bills, buying a car. And the reason that you do that is because while you're earning interest inside of your cash value, you are accruing interest on the loan side. But what infinite banking does is it creates a scenario where you are paying less interest on the loan side than the interest you're earning on the cash value side, creating an arbitrage between the interest rates. Instead of getting a paycheck, putting it in your bank account, using it to pay your bills, they're saying get a paycheck, put it in your life insurance cash value, take loans against that to go and pay your bills, buy a car, whatever. You may choose to pay the loan back, but you may not. If you don't, it's not a big deal because you're getting this interest rate arbitrage. So this is a system that takes over your whole financial world.
If it works exactly as it's been taught, then maybe there's real value, but there's some real challenges that come with it. When you say it tries to do too much, there's an element of complexity that comes with trying to integrate your entire financial world into life insurance policies. And I can just tell you from experience dealing with life insurance companies for the last 20 years that they're not very good at banking. So if that's your goal, you might leave unsatisfied, to say the least.
They're not good at banking, and things happen in life. So in other words, if I've created this system that I'm flowing money through this, but then I lose my job or I have unexpected expenses or I have other things going on, it can interrupt the whole system and turn it on its head, and all of a sudden it's gone.
Firstly, infinite banking definitely tries to do too much. The next thing that we want to hit on is that it's completely based on interest rates. Okay, so that doesn't sound good or bad, Rod. Why is that a problem? Why would that be a reason to avoid it? Interest is good.
Interest is good. And what it's doing is it's counting on that you will always earn more interest in your cash value compared to the interest you're accruing on your loan. Now, recently, as interest rates have been going higher, that's not necessarily the case. So think of it this way. If the whole system is based on earning more interest in my cash value than the interest that I'm paying on my loan, but all of a sudden that gets flipped upside down and I'm accruing more interest on my loan than what I'm earning in my cash value, you can see this is a problem, right? All of a sudden I'm going backwards. I'm eating up all of any profits that I may have gotten in the past, or especially if I'm new in the system, it's just not working for me at all.
So if you're not doing it with exactness, right? So if you're not paying interest consistently, it could be a landmine, basically, is the issue. And what's really sad is that when that happens, you could lose a lot of money that you paid on the front end to establish the policy, right? So it's not just that your money's going down based on interest, it's that there was a cost that I had to pay in order to capitalize and become part of this system to get the policy, and suddenly I've lost that and I've lost the money that's in it. So messing up on it, there can be really big repercussions, especially if you're somebody that's just gone all in on it and you're like, hey, I'm taking my paycheck, I'm putting it into my life insurance policy, and then I'm flowing it around after that. And the third one is that it doesn't really replace the bank. This is the one that I've been harping on for years, because when I was initially taught this concept 15, 20 years ago, the idea was that it would actually replace the bank logistically. And what I'm telling you is that it doesn't. It doesn't work like it's said in any way, shape, or form. Now, there's huge value in high cash value life insurance, which we'll talk about in a second. But as far as the infinite banking concept actually replacing a bank, well, here's the deal. Banks, and why we talk about this, I just don't know. Banks have the ability to lend out $1 multiple times. And every time I've heard this conversation, they're like, hey, we can tap into fractional reserve banking. And guess what? We don't have access to fractional reserve banking. So if someone teaches you about that, just be like, okay, great, but that doesn't apply to me in any way, shape, or form. And now you're getting to like the baseline of it. So just know that if you're getting into infinite banking and you're actually expecting it to replace the bank, and if you're actually thinking that you're going to be able to go out and lend money multiple times, because sometimes it can come across that way, just know that that is 100% not the case. Okay, I want to shift, Rod, and I want to talk about the value that high cash value life insurance actually does provide. So let's focus on what we call investment optimization.
Yeah, and we'll hit each of the 3 points one by one. So the first one is in the investment optimizer, we are focused on improving the returns on our investments. We're not trying to replace all the money that's flowing through all of our lives. We're actually using it in a place where we create value. So it's not the consumerism side of it where we're just trying to create this interest rate arbitrage. We're creating a system flowing in and out of our investments that literally creates an additional layer of profitability on those investments. And again, I'll say it again, it's because we're doing it at a place where we're creating value.
Yeah, it really is. It's all about optimizing them. It's about math, right? We're utilizing math to our advantage, but to your point, not basing it solely on interest rates. We're basing it on our own ability to go and invest money against the cash value, borrow against my cash value using a loan against the insurance company's money. I go and invest that, create value. And now I've got something that really works. But the other thing is it's not going to be nearly as intricate, right? Because when I go out and invest, I don't have 50 transactions in a week. I have maybe I have a couple a month or something like that. That's the way that an insurance company can handle banking. It does not do well if you're trying to be ultra transactional and, flow money in and out of it on an ongoing basis. You'll just likely get frustrated. So I think that's a really important point, Rod. What is the next reason that we really like high cash value life insurance, but not for infinite banking?
Yeah, so we talked about how infinite banking is completely based on interest rates, creating that arbitrage between what I'm earning and what I'm paying. And in the investment optimizer, it's more about the system and the flow. So in other words, as I take a loan and I go and invest with that money, and that investment kicks off cash flow, I flow that back towards my plan, I'm paying my interest as I go. What that means is I'm paying simple interest on the loan side, but I'm earning compounding interest in the cash value while it stays there and just continues to grow. And what that means is I'm not counting on this difference in interest rates, because difference between paying simple interest versus earning compounding interest exists even if the rates are going the other direction. If I'm paying a higher interest rate on the loan than what I'm earning on the cash value, that doesn't mess things up because I'm still paying simple interest, even if it's a higher rate, but I'm earning compounding interest. And that makes a huge difference over time.
So what's the bottom line?
The bottom line is that it is hyper focused on improving your investing. It is based on this arbitrage between paying simple interest and earning compounding interest. And third, it's not trying to replace the bank. It's just creating a system within the investing that you already are and will be doing anyway, just to improve the returns that you're getting on your investments.
Okay, so don't do infinite banking. Do use high cash value life insurance for investment optimization. Click the button below. Let us know whether you agree or disagree with us.